Making money in the trading market is tough, and earning $10 million sounds like a fantasy. But 24-year-old Jack Kellogg from the United States made it a reality, and he did it in just over 2 years. Between 2020 and 2021, he earned $8 million. By June 2022, his account had surpassed the $10 million mark. What's even more impressive is that it all started with just $7,500. Hello, welcome to the Speculation Lab. This journey was anything but easy. Jack faced serious health challenges, exhaustion, failures, and a variety of complex market conditions, including the 2020 market crash, the 2021 bull market, and the 2022 bear market. Throughout his growth, his trading system became more refined and efficient. He even gave it a catchy name, KISS, short for Keep It Simple, Stupid. Next, I'll share 2 high-probability models from Jack's KISS strategy: Breakout trading and intraday trading. Make sure to hit the subscribe button and stick around until the end. First, let's talk about the breakout strategy. Kellogg's breakout strategy relies on analyzing weekly and daily charts of the S&P 500 index or the Nasdaq 100 ETF to identify major market trends. If these key indices have been consistently trending upward over the past month, and especially if they've hit new highs in the last week or two, he considers it a prime opportunity for a breakout trade. Markets move in cycles, and price trends are heavily influenced by trader sentiment. As prices rise, optimism grows stronger. However, Kellogg avoids chasing the top. Instead, he prefers to enter during the middle of a trend, where the upward momentum is more stable. Before trading, Kellogg uses tools like Stocks to Trade, Finviz, and TradingView to screen for the top-performing stocks of the day. His focus is on 2 key factors: high trading volume and significant price increase. A high trading volume indicates active participation in the stock, making it easier to enter and exit positions without significant price slippage. High volume also reduces the likelihood of price manipulation. Stocks with significant price increases demonstrate strong upward momentum and reflect heightened market interest, often signaling the potential for further gains. Kellogg avoids stocks with extremely low trading volume, such as those with only $500,000 in daily volume but a 300% price increase. These stocks often suffer from poor liquidity, making it difficult to trade, and their wild price swings are frequently the result of manipulation, presenting a high level of risk. He focuses on stocks with trading volumes ranging from tens of millions to several $billion and short-term price gains of 50% to 100%. Once he identifies potential candidates, he adds them to a watch list and examines their price action over the past 2 to 3 weeks. Stocks that fail to maintain new highs or break key support levels are eliminated from consideration. For the remaining stocks, he checks for relevant news, analyzes the catalysts driving the price increase, and evaluates how long the momentum is likely to last. On July 27th, Blue Water Vaccines hit a new high after announcing plans to develop a monkeypox vaccine. However, pharmaceutical news often comes with complexities, such as long development cycles and significant uncertainties. As a result, price increases driven by such news are usually short-lived, making it essential to approach these trades with caution. Once short-term profits are secured, it's crucial to take profit promptly. If holding the position, the stop-loss should be quickly adjusted to the entry price to ensure no losses even if the stock pulls back. If the news has a broader impact, such as regulatory approvals, new market opportunities, or major events, the stock may have greater potential for sustained price increases. Kellogg closely monitors the price action of these stocks to identify trading opportunities. His go-to approach is breakout trading. Specifically, he looks for stocks that remain near their highs after a sharp rally lasting 1 or 2 days or break through key resistance levels with high volume. When the weekly or daily trends of the S&P 500 or Nasdaq 100 become unstable, Kellogg shifts his focus away from broader market trends and instead prioritizes intraday trading to adapt to changing conditions. Kellogg frequently uses the volume-weighted average price, VWAP, as a key indicator in his trading. VWAP combines trading volume and price data to show the average market price over a specific period, making it a valuable tool for identifying trends and making informed trading decisions. His trading rules are straightforward. If the price is above the VWAP line, he avoids taking long positions. If the price is below the VWAP line, he avoids taking short positions. Kellogg also uses VWAP to determine exit points. For example, if he shorted a stock at $9 and VWAP is at $7, he would close the position near $7 to lock in profits. Kellogg places great emphasis on volume as a key indicator and uses abnormal volume spikes to spot potential reversal opportunities. When volume surges suddenly, it often signals that a large amount of capital is flowing into the market. This typically indicates that many traders are chasing the rally, leading to overheated market sentiment and positioning the majority on the wrong side of the trade. If a significant volume spike occurs near the day's high or in a well-known resistance zone, it often suggests an impending reversal. In such cases, Kellogg seizes the opportunity to short the stock. Kellogg believes that the strength of a price level can be roughly assessed by observing how often the price reaches that level and how long it stays there. If the price lingers at a certain level for 30 minutes to 1 hour, it usually indicates that the resistance or support at that level is relatively strong. While data and strategies are accessible to everyone, what truly determines success in trading is discipline. Even the best strategies and indicators can lead to losses if not executed with strict adherence and consistency. Successful trading relies on consistently executing proven strategies that have worked in the past, but markets are rarely clear-cut. When losses occur due to mistakes, many traders fall into the trap of revenge trading, making impulsive decisions under emotional distress. This often leads to even greater losses. If a trade goes against you, it's crucial to accept the loss and exit the position promptly. Take time to reassess the market with a clear mind, rather than trading in an emotional state. Even traders like Kellogg, who strictly follow their strategies, achieve only about a 62% win rate. Losses are an inherent part of trading, and success depends on two key factors: emotional control and limiting losses. All right, don't forget to hit the subscribe button to stay updated with more profitable trading contents. I wish you a good morning, good afternoon, and good evening. Goodbye.